Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Post-Mortems.
On today's special segment, we have Neha Khera of 2048 Ventures. Neha, can you tell us the story about a portco that failed and why it failed?
Yeah, for sure. Lots of examples, but I was thinking about a portco that had built a really transformative piece of hardware. I won't tell you too much about it, but it was a new form of glass and could be leveraged in settings where you could actually change the properties of the glass and what's shown on it. And, you know, some of the applications that they were thinking through were really, really very interesting, super strong team, very technical, very brilliant, but they couldn't commercialize it and they couldn't sell. And I do think that, you know, being an engineer myself, sometimes I get overly excited by other strong technical founders and really need to think through the commercial aspect, because you can build interesting tech all day long in your garage, but if you can't sell it, the company's not going to go anywhere.
Is it a prerequisite now that there's a salesperson on the team or someone that has the commercial aptitude?
Yeah, we actually really think about it from the CEO standpoint. Is the CEO commercial enough? Because they are ultimately the ones in the role at the early stages that need to be driving sales.
On today's special segment, we have Ravi Viswanathan of New View Capital. Ravi, can you tell us a story about a portfolio company that failed and why it failed?
So this is years ago, 15 years ago. So we had success with an investment called TeleAtlas, which is a proprietary map database. This is before Google Maps, really selling the European market. We had a really fantastic exit. It was really a proprietary database that had significant barriers to entry. And then, so that was on the heels of a very successful investment there, we invested in a company called Gentro, which was really the next instantiation, really taking it to the mobile market. Before, they used to be called PNDs, personal navigation devices, wireless, right? This is actually before the iPhone, or right around the iPhone was getting started. And so it felt like an interesting bet and an interesting tangential and extrapolation of a very successful investment. But pretty quickly after we invested, Google Maps came out. It became free. That was something that just really cleared out all of those software providers that actually try to make a living selling these. It had turn-by-turn navigation. It had some things that Google Maps didn't, but that was kind of a macro force that was just too powerful, and we had to let that one go. So that was definitely a failure.
Yeah, how do you think about, I guess that was somewhat application layer, but how do you think about when you're doing infrastructure investments? You invest in enterprise SaaS and in infrastructure layer stuff. Do you have any thoughts or insights on how to diligence and think about risk when some of that infrastructure is dependent on maybe a method of technology building or a type of platform? You know, it's got that dependency.
Yeah, I wish I could tell you there's a great way to diligence it. You know, we've had one example is open source. We've had some great open source investments, some that are okay. And then that presumes that community that actually is your competitor because it's free, right? You can build modules that have enough value that someone's willing to pay for it. So that's one example. I think on some of these others, I think for us, we try to stay very close to the developer community, stay close to the customer base, and really diligence how fast the adoption is and how much better this technology is, because that's what gives you a little bit more runway, right? If it's just really taking off and if it's early stages and people swear by it. And this is all what, you know, some of my favorite investors in my career have said, this is really just the heart of product market fit. It's trying to nail that. And, you know, you just hope that you get into those that really can take off, because we've seen both sides.
On today's special segment, we have Ali Hamid of CoVenture and Crossbeam. Ali, can you tell us a story about a portfolio company that failed and why it failed?
So there's a whole bunch of reasons. I think the two that I'll pick on, sometimes founders get dogmatic And so they'll have a point of view on the world and they're not good at changing their point of view. And I think changing your point of view and changing how you do things doesn't always mean you're wrong, but it can feel like you were wrong. So one example that everybody's going through right now is that in 2021, people were giving advice to founders about how they should be hiring, how they should be growing, how they should be approaching the market. And it was like the right advice for the time. Like if you had a really good idea, there was going to be 9 competitors right behind you because raising money was so easy. And so you had to grow really quickly. And by the way, you had to scale really fast, and scaling is really hard. You know, if you're growing 50 to 100% year over year, you have time to learn your job. You know, if you're a CEO of a company that has 5 people versus a company that has 20 people versus a company that has 100 people, your job is different as a CEO. And it probably takes you like 6 to 12 months to get good at that job before you have to go to the next one. But if you're in a company that's growing like crazy, you never get to learn your job. And so you have to make a lot of senior hires because your junior people can't level up either. And you have all this lateral hiring complexity because lateral hires are much harder than junior hires so you can grow. And so then all these VCs are giving this advice that you had to make these senior hires, that you had to grow really quickly. And then, you know, the market pulled back and the advice became different. But just because you were changing your mind doesn't mean you were suddenly stupid in 2021. You were just taking new inputs. And sometimes fundraising markets change. Sometimes like your customer changes. Sometimes the regulatory market changes. And when you get too dogmatic and you feel like, crap, I have to like admit that I was wrong to change my mind. Like you're not admitting, it's not a stupid thing. Like changing your mind is actually a really amazing thing. It's always why I've hated the term flip-flopping in politics. Like when somebody's a flip-flopper in politics, okay, so they learn new things and they change their mind. Why does that make them a bad person suddenly? So I think dogmatism, I think, is a really, really challenging problem. And the other is just CEO scaling. So, you know, what you have happen is like a seed company goes to a Series A company, they're growing 100 to 150% year over year, whatever it is. And what it takes for the CEO to hire a VP of sales, train that VP of sales, and build a sales function that scales beyond them is really challenging. And it often requires a recognition that your growth will slow for a year or two. And either you are unwilling to let your growth slow, but you'll do unscalable things, or you're willing to let your growth slow and even miss your plan a couple times, which your board needs to get comfortable with, but you can grow scalably. And watching CEOs and boards be dogmatic about their growth plan and be unwilling to take a step back today to take 2 steps forward tomorrow is, I think, often why Series B and C companies sometimes never get to where they could be.
Interesting. On the former point around dogma, is that something you can screen for during selection?
It's hard. I mean, it's really hard to screen broadly during seed stage or early stage investing because you only get a few weeks to meet somebody. And, you know, kind of, you start seeing pattern recognition. You know, if you're meeting a founder and you're asking like, what about this? What about this? And they get defensive and they like almost get mad that like, how dare you question them? Those are really easy passes. But, you know, there's founders who are really good salespeople who will convince you they're more coachable than they are. And I hate the term coachable, by the way. I have nothing to coach them, but the world has lots to coach them on. And, you know, I think when people say coachable, it's implied like, oh, I'm the VC, I have all this wisdom. I really hope the founder listens to me. I don't care if they listen to me. I just care if they listen to the data they're getting.
Right.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.